Tell me about the land.
The land.
The land, the buildings, how that whole aspect of it works.
Hey guys, and welcome back to another video. Today we are going to be talking about how real estate investment trusts can generate income and provide inflation protection in retirement. That is a big sentence, so we will break it up into two parts and then connect them. We will talk about real estate investment trusts and how income and inflation protection is important while retirement. So without further ado, let's get us straight into it. So what are real estate investment trusts? A real estate investment trust, REIT, is a business that owns, operates, or funds income-producing properties. REITs, which are similar to mutual funds, combine the money of many different investors. Individual investors may now profit from real estate investments without having to acquire, manage, or finance any of the properties themselves. REITs were created by Congress in 1960 as part of the Cigar Excise Tax Extension. The provision permits investors to purchase shares in commercial and real estate portfolios, which were previously exclusively available to the rich and through major financial intermediaries. Apartment complexes, data centers, healthcare facilities, hotels, infrastructures like fiber cables, cell towers, and energy pipelines, office buildings, retail centers, self-storage, timberland, and warehouses are examples of properties in an REIT portfolio. REITs are real estate investment trusts that specialize in certain real estate industry. Diversified and specialized REITs, on the other hand, may have a portfolio of multiple sorts of assets, such as REIT that owns both office and retail facilities. Many REITs are listed on major stock exchanges, and investors may buy and sell them much like stocks at any time throughout the trading day. These REITs are generally traded in large volumes and are considered liquid assets. The majority of REITs operate on a simple business model. The REIT leases space and collects rents on the buildings, then distributes the money to shareholders as dividends. Mortgage REITs do not own real estate. Instead, they finance it. The interest on their assets is how these REITs make money. A firm must comply with certain criteria of the Internal Revenue Code to qualify as an REIT (IRC). These conditions include predominantly owning long-term income-generating real estate and distributing profits to the shareholders. To be classified as an REIT, a firm must fulfill the following criteria: invest at least 75% of total assets in real estate, cash, or U.S. Treasuries. Derive at least 75% of gross income from rents, interest, and mortgages that finance real property or real estate sales. Pay a minimum of 90% of taxable income in the form of shareholder dividends each year. Be an entity that's taxable as a corporation. Be managed by a board of directors or trustees. Have at least 100 shareholders after its first year of existence, and have no more than 50% of its shares held by 5 or fewer individuals. REITs are divided into 3 categories. Equity REITs are companies that invest in real estate. The majority of REITs are equity REITs, which own and operate income-generating properties. Rents are the primary source of revenue, not by reselling properties. Mortgage REITs are a type of real estate investment trust. Mortgage REITs provide money to real estate owners and operators directly or indirectly through the purchase of mortgage-backed securities. The net interest margin, the difference between the income they receive on mortgage loans and the cost of funding these loans, is the main source of their profits. Because of this approach, they are susceptible to interest rate rises. REITs that are a mix of stocks and bonds. These REITs combine equity and mortgage REIT investing techniques. By acquiring shares via a broker, you can invest in publicly listed REITs, REIT mutual funds, and REIT exchange-traded funds, ETFs. A broker or financial advisor that participates in the non-traded REITs offering can sell you shares of a non-traded REIT. An increasing number of defined benefits and defined contribution investment plans incorporate REITs. According to Narrate, a Washington, D.C. based REIT research business, an estimated 87 million U.S. individuals own REITs through their retirement savings and other investment accounts. Now, let's talk about why it is important to generate income and be protected from inflation during retirement. So, most Americans are probably unconcerned with inflation, yet it has a big impact on their financial lives. Inflation has an impact on consumer pricing, but it also serves as a benchmark for the federal government when deciding whether to boost contribution limits in eligible retirement plans or enhance monthly Social Security payments. The pace of inflation impacts how much your retirement savings are worth on a personal level. It has the potential to deplete your savings account over time. Understanding how inflation may affect your retirement strategy is critical to ensure that you have sufficient assets to endure into your golden years. The figures are shocking when it comes to the real amount of money that inflation may cost seniors. The LIMRA Secure Retirement Institute developed a model to show the impact of inflation on the average Social Security income over a 20-year period. According to their calculations, a 1% increase in inflation would eat up $34,406 in retirement benefits. If the rate of inflation rises to 3%, the gap will be more than $117,000. The impact of inflation on seniors' purchasing power is their major worry. Even if inflation remains low, this is true because seniors are more likely than younger consumers to spend money on items that are subject to price increases, such as healthcare. According to the Center for Medicare and Medicaid Services, CMS, older Americans spent 3 times as much on healthcare per capita as working adults and 5 times as much as children in 2014, averaging $19,098 a year. The CMS estimates that healthcare spending grew by 4.6% overall in 2018, the latest recent statistics as of December 1, 2020. Inflation averaged 2.4% over the same time period. That means that even if inflation is low, retirees will be impacted harder than others since the prices that directly affect them tend to rise. When the Social Security Administration (SSA) fails to give a yearly cost of living adjustment for individuals receiving benefits, low inflation becomes even more troublesome. Healthcare isn't the only thing that might increase a retiree's costs. The amount of money spent by seniors is also influenced by factors such as housing, travel, and supporting adult children. According to the Employee Benefits Research Institute, 45.9% of retirees spent more in the first 2 years following retirement than they had in previous 2 years. Over the same time period, 28% of households spent 120% of their pre-retirement income, indicating that some seniors may be suffering lifestyle inflation. So how can you generate income and protect yourself from inflation by using real estate investment trusts? Real estate investment trusts are a good option for retirees who are concerned about inflation eroding the value of their income. REITs are real estate investment trusts that own and or run retail malls, office buildings, warehouses, and apartment complexes. Experts note that while they have a higher risk than certain other income-producing assets, such as Treasury bonds, they also have built-in inflation protection. In general, REITs do well in inflationary times simply because of their capacity to increase rents and then pass that revenue on to shareholders, said Marco Rimasa, president of CFE Financial in Katy, Texas. Inflation has been on investors' thoughts as the United States begins to return to pre-pandemic economic activity. The core personal consumption expenditures price index increased 3.4% in May compared to the same month a year ago. Another indicator, the consumer price index, increased by 5% in the same time period last month. Given where the economy was a year ago, still reeling from pandemic-related shutdowns, Federal Reserve officials believe the price increase is just temporary. REITs, on the other hand, could be a good option for retirees looking for a stable income that is less affected by inflation. According to Morningstar Direct, almost $1.5 trillion is invested in REITs in the United States. REITs must pay out 90% of their taxable revenue to shareholders in the form of dividends due to their legal structure. These payments are usually made quarterly or regularly, according to Rimasa. According to industry trade organization Nareit statistics from May, the average dividend yield for REITs is around 3%. In comparison, the yield on the benchmark 10-year Treasury bond is 1.5%. However, regardless of inflation, not all REITs perform the same way. For example, the elements that drive the performance of a hotel differ from those that drive the success of, say, a senior living facility or warehouse space. If you enjoyed the video, remember to subscribe if you already have not and like the video. It takes 5 seconds of your time, and each and every one of you means a lot to us. Until next time, have a nice day.